You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to watching the Financial Survival Network. I'm Kerry Lutz. Well, you know, for past 11 years, I've been doing Financial Survival Network, 7,500 podcasts, always looking to find a better way to make money, a safer way, and in many respects, an easier way. I've known about this form of investing for over 40 years, and I figured you would want to know it too, talking about this concept of the net. I'll let our guest explain what that is, but nets can really, if you hit the right one, make you a boatload of money. Evan Blaker is with us now. His site is netnethunter.com. Evan, a pleasure to have you on. So first, what is a net? And why should you care about it?
Well, first of all, thanks for having me on. It's nice to be able to talk about this. So a net, I mean, if you think about a low price to book value stock, those are fairly easy to kind of conceptualize. Just the market cap is below the book value of the company. That's a low price to book stock. Now, with a net, we strip out the long-term assets and we just focus on the current assets. So it would be your current assets less total liabilities, and then that resulting figure, if the market cap is less than that, then we would call that a net.
Okay.
So,
all right. So high liquidity, meaning that the current assets, which are assets, either cash, investments, or assets whose value will be realized within the next 12 months, those are considered current assets. Sometimes companies have a bunch of junk on their balance sheet, though, so you have to filter that out, right?
Yeah, absolutely. But if we exclude a lot of the long-term assets, that kind of takes care of most of it. We don't tend to find a whole lot of junk in the current assets, the current asset section of the balance sheet. Sometimes you do, but it's not as complicated as, trying to get a true net asset value in an equity situation or a book value situation.
Okay. So tell us, share with us some of your successes in the past and maybe a couple of your failures.
Yeah, sure. So I found a company called support.com, and this company was, as the name implies, it was a support company. They helped businesses with outsourced support services. So you would call into them and they would field all the questions for these companies and anything. So support.com was trading below net cash, which means that, instead of just all the current assets, we're just looking at the cash situation. So the cash less total liabilities. So it was trading below that value. And some activists had just wrestled away the company from management. So they were busy trying to turn this company around. Now, when I came across it, the battle had already been won, and they were just at work trying to improve the company. Now, the nice thing about nets is that, we have this net current asset value, but then there is a separate business value that you can consider as well. So if the company is viable, and it will improve its situation going forward, it's worth asking what this company is actually worth. And I pegged support.com at somewhere between $9 and $12. Now, it took a number of years, but finally, the company turned profitable and then got a buyout offer for about $9 a share, or I should say merger offer. And it was valued about $9 a share. So the stock went up from basically $1 after a special dividend all the way up to $9 within 3-4 years or something like that. Now, the real kicker is that after this jump happened, the GameStop gang, they've been active in the markets. They saw the company and they jumped on it. So it actually went up to, I think, $40 or $50. But of course, I was well out by that time. I didn't see anything close to those type of returns. So that's one company that that was quite good as a net. Biggest failures, the only failures that I've really had is when I haven't stuck to my process. So I bought a little company in the Ukraine. It was a little shipping company. It was dirt cheap. Had a nice liquidation value. This was back a couple of years ago before the whole Russia situation. But, Ukraine isn't the safest jurisdiction to invest in if you're wanting to invest in stocks. But, I bent that rule, and management just kind of left with the cash. So I'm stuck here with some worthless shares in my account, reminding me every single day to stick to my principles. So
right. That's interesting. And I followed a stock for years. I never bought it. But back when we had the S&P booklets, we didn't really have, I'm kind of dating myself here, we didn't have online access to every piece of information, every public filing, and you really had to research stuff in a whole different way. I never bought the company, but it was like one of 2 or 3 nets on the S&P at that time. We're talking like close to 30 years ago. I followed it for 5 or 6 years and I kind of gave up on it. And then like a year or 2 later, I saw they were acquired, and basically for, the liquidation value plus a multiple. And when I figured it out, I would have had an annualized return looking back of over 20%. So the one thing, and one thing I'd like to point out is that Benjamin Graham referred to this as the margin of safety, because after a stock is down so much, your risk of it is basically a risk of it going out of business. Financially, a stock could always go lower. It can go to zero, but in all likelihood, it's gone down 95%, probably not going to go down much below that. So you get the margin of safety. But on the other hand, these situations have become exceedingly rare in the United States and around the world. How many of them are you following at this particular moment, Evan?
So we run 2 screens on NetNet Hunter, and the first one is kind of a bulk list of NetNet stocks. They're statistically meet the definition of being a net, and there's around 1,000 on them globally. There's roughly 1,000 that we've found. Now, as you might imagine, they're not on the S&P these days. They are micro cap and nano cap companies, and a lot internationally. But we filter that down to about 40 or 50 now that we consider very good companies to follow up and do some research on. So they're buyable, low debt levels. The business is not eroding that quickly. So.
And so obviously we're talking value investing here. I should have made that clear from the start. But value investing hasn't been in vogue for many years. It's underperformed for the last several years. Do you think that's going to reverse?
I mean, absolutely. What we've seen over the last 10 years is basically an inflation cycle, or the first half of an inflation cycle, I should say. Basically, anytime that the Fed or the government introduces a lot of cash into the economy, what happens is you have a lot of financial assets that really start taking off. That's when your growth stocks really come into vogue. You see bubble companies that are effectively Ponzi schemes really taking off and capturing the public eye. As part of that, as these type of cycles get going, they tend to suck up all the capital. So a lot of the cash that would normally go to your cheap stalwart blue chips or beaten down companies that offer a significant amount of value, suddenly they're chasing pie in the sky, the Teslas that are trading at, 400 PE. But, eventually the cycle turns. And I think that we've definitely passed the turn stage. Over the last year, you can see a lot of the tech stocks that were darlings in, over the last 5-10 years have just been hammered. And as this happens, people tend to cycle back into the classic value plays, the cyclicals, that sort of thing.
All right. So Benjamin Graham, he had a definition of investing, and I'm going to find it. I'm going to pull it up here. Basically, I will paraphrase it, and that is that, and this was, mind you, 60, 70 years ago, that
Right.
An investment is one that you can basically project out their earnings and their dividends. It actually will give you a return. Everything else is speculation. Does that definition still apply?
Yeah, but I think he probably gave a couple different definitions over the course of his life, and I like to go back to the 1940s, 1950s books that he was writing, the security analysis books,
Right.
and how he summed it up in those books, anyways, was that an investment is basically when your position guarantees safety of principal and an adequate return, and then everything else is speculation. Well, I mean, Buffett has also said that, if you don't lose money, everything else is, not losing money is is rule number one. And rule number two is don't forget rule number one. But if you don't lose money, the rest of the outcomes tend to be pretty good. So what I try to do is I try to protect my downside quite a bit by putting in specific filters, and then I look for catalysts or reasons why the stock is going to perform much better in the future. And I think that type of investing is probably the best that you can do, at least in this environment.
Yeah, I found the definition here. Thank you, Google. An investment operation is one which, on thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. So,
Right.
And that's kind of universal. But nowadays, investment and speculation really are the same thing.
Don't just survive, thrive. The Financial Survival Network.
Trilogy Metals is a world-class developer in Alaska's Ambler Mining District. The company already possesses 8 billion pounds of copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and now over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion with a 33% IRR. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades on the New York and Toronto exchanges under the ticker symbol TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com.
This is the Financial Survival Network. The information you need to thrive now more than ever.
I mean, people like to say so, or people, it's definitely captured the public mind to think that an investment is anytime you buy or sell a security, option, whatever. But Graham would say, no. There are certain principles that have to be in play. Your principal investment has to be protected. And then there has to be, a certain likelihood that you're actually going to be profiting from it. And I think that, people can call something investment or speculation as much as they want. And the definition is definitely free to move. But if you stick with Graham's principles, generally speaking, you don't lose money. And, Buffett said that anybody who kind of comes out of the Graham school that he's known has done well over time. So,
yeah. So one thing that Buffett does, though, is that he attempts to assign enterprise values for trademarks like Coca-Cola, and
Right.
that really are proprietary businesses. He says he likes moats, that type
Right.
of thing. really, Graham never put a value on the company's IP or their market position or anything else. For him, it really was a straight mathematical calculation.
Right. And he was trying to come up with formulas or principles or strategies that really the everyday investor could follow. So at some level, he knew there were better ways to make money than just the principles that he was advising. If you're really, really skilled and you want to put in, 40 hours a week doing this type of stuff. But his goal really was to make investing accessible. Now, if you look at somebody like Buffett buys all these great companies, and really, if you read what he's doing in the comments that a lot of other really gifted, famous investors say basically you can't, or they're not able to match what he's doing. They're not able to find as good companies as he does. Now, if you look at say the net strategy, I think Graham cited 20% returns over 20, 30 years, something like that. Buffett did 30, as far as I can remember, over about 12 years when he was running his partnership. So just using that basic approach, simple techniques, you can actually earn, quite high returns. Buffett shifted to the moat strategy really because he had too much money to put to work in these net positions, or these cigar butt stocks, as he called them. And so in the 70s, early 70s, he started buying, great companies for great prices. He wasn't yet at the fair companies for okay prices yet. Yeah. But so he was buying, American Express for 25% of the value of, whatever it was worth. So, but even today, Monish Pabrai recounts where he was going into Buffett's office, and there's a handbook of these Japanese securities on Buffett's desk, and Buffett's still combing the books looking for these dirt cheap cigar butts. So
interesting. So he still hasn't totally given up his roots. You raise an interesting point, and that is that institutions many times can't enter these companies because the market cap's too low. They can't get a meaningful enough position. So this is an instance where the individual investor really does have one up on Wall Street.
Yeah, I mean, this is one of the few areas where if you're managing a very small amount of money, you're an individual at home in your den, you have a significant edge over, BlackRock or any of these Wall Street banks or any of these big pros, even Buffett himself, because you can look at these companies that are $5 million in market cap and only trade $500 worth of shares per day. You can find these mispricings. You can find these catalysts that nobody else is looking for, and let alone can buy. So, yeah. And not to mention that when you get down into these tiny market cap areas, the number of companies just explode. So there's, S&P 500 companies, right? The Dow has 10. If you go all the way down to, the micro cap and nano cap companies, suddenly you're talking about tens of thousands. Yet the competition among those type of firms is not generally sophisticated, and so it's just a lot easier hunting ground.
All right. So what's like the largest market cap net that you've found? You don't have to name names because obviously you want people to subscribe.
Right. So the largest one I think I found is about 300-400 million. But to be honest with you, when you're looking at companies that are that big, the net strategy tends to go down in performance quite a bit. So what we try to do is we try to cap our market cap at about 100 million US. And we really don't want to go much above that because the returns really degrade. Now, the flip side is also true. So if you're looking at companies that are 1 million or 5 million or 10 million, the returns statistically are substantially higher. So
True. Hey, so what about an investing theory like the dogs of the Dow, or even the dogs of the S&P 100? Okay.
Yeah.
So one thing Ben Graham said is that larger companies are much more likely to weather bad economic times than smaller companies, just by the amount of resources they can bring. Do you think that that strategy has validity?
I mean, I used to use Dogs of the Dell. Interesting story way back 20 years ago when I was a young buck. Um, but yeah, I don't know. Anytime you're buying two companies, I'm not sure if I'm comfortable with that. Even going up to five companies, I'm not really comfortable with that type of concentration. In terms of weathering financial crisis, yeah, definitely. I mean, Coca-Cola can probably weather another Great Depression without much issue, just because it has significant barriers to entry. It's a cash flow titan. Companies that have significant moats around them and are really cash flow machines can do fairly well. But it really depends on the given company. A lot of these nets that I'm looking at, they are staple businesses and they have buckets of cash on the balance sheet. So if we're going through anything like a 2-3 year major crisis, they should be able to weather those storms without issue. So yeah, I don't really know. Another thing to consider, though, is if you're going into a period where the rates are increasing and will be increasing, seemingly going to be increasing over the next couple decades, what does that do for your PE ratios and your discount cash flow valuations? Anytime you raise the risk-free rate, those valuations, anything valued on an earnings multiple or through discounted cash flow, they have to be valued lower. But, if you're looking at a situation where the company has a bunch of cash on the books, well, suddenly that cash is a little bit more valuable because it can earn a little bit higher interest on it. But even if there's no cash on the balance sheet or very, very little cash, and we're looking at, fixed assets and stuff, the liquidation value of that firm doesn't change much based on rates. So in that sense, you're much more protected. And then if you're entering a situation where you see significant inflation taking off, then it really pays to have staple fixed assets because, those asset prices are going to increase. So.
Okay, interesting. So just tell us about NetNet Hunter. Your site, netnethunter.com, what a subscription looks like, and how you can get started.
Yeah, sure. So NetNet Hunter is really a tool that I made for my own investing. And back about 10 years ago, I wasn't able to find many of these net nets anymore. It was getting really, really tough. So a friend of mine said, well, why don't you, start a website? You can hire somebody to screen the international markets to try and find all these things, and we do it all by hand. So that's where NetNet Hunter was born, and I decided to take on a bunch of other members who can kind of share the cost of doing that, and it's turned into really a membership community. So it's a tight-knit community that focuses on these sub-liquidation value companies. A lot of discussion, sharing ideas, focused on net current asset value, net working capital, low price to NAV, that type of thing. But our primary focus is on net current asset value. So in terms of a membership, it's $500 US per year. And you get access to our raw screen, our short list. There's analysis that comes up once a month. There's a community forum and learning resources. And that's really the bulk of the membership. And I should say that, even though there's computers and software and screening tools, you really need to dig past the standardized data to really understand, whether you have an opportunity or not. Now, if you're faced with, 1,000 international companies, we might find only, 40 to 50 that are even worth examining further. And so that takes our analyst something like 30 hours a month to do. So, saving 30 hours for $500 is not not that bad of a bet. So it's a pretty good deal that way.
Definitely a good investment. Well, the site is netnethunter.com. There's a link in the show notes to this interview on financialsurvivalnetwork.com. Hey, if you haven't subscribed to our free newsletter, please do. And if you got a question for Evan, just shoot me an email, kl@kerrylutz.com, and we will get you an answer. Evan, a pleasure. Thanks so much, and good luck, and we'll talk to you again.
Thanks. Great to talk to you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.